Bilal Hafeez joins us, CEO and Director of Research at Macro Hive. Bilal, really nice to have you with us this Friday. Now, before we can get to the weekend, we have to get through the payrolls report, so let's do that. We were just hearing the Deutsche Bank expectations there, less than 100,000, that would be bad news. But anything around the 150,000 mark, he thinks the market can live with that kind of number. What are your expectations today?
Well, great to be here, Anna. My expectation is we actually have an AI model that predicts payrolls. It's had a really good track record over the course of this year. And surprisingly, it's actually forecasting a 190 print for payrolls. So it's expecting an upside surprise. Now, of course, it won't always be right, but our model is actually leaning to the upside. So we're actually looking for, reversal of some of the moves that we're seeing today. Now, more generally, I would say that if we were to go below 160, even if it was 150 or 140, I do think the market would take that quite poorly overall. OK, yeah, it's interesting. So you say your model is skewing to the upside here, an upside surprise. We were hearing from Paul Dobson, our colleague in Asia earlier on, that if he looks at options markets, there's a lot of negativity around the dollar, and we already see that the yen is gaining, as if the market is maybe expecting something weak on payrolls. What do you make of that kind of positioning? Because, of course, dollar-yen, there's been a lot of focus on that since the beginning of August when we saw such a lot of movement there. Yeah, I would say there's two things there. One is that, in general, if you look at the behavior of, for example, dollar-yen around payrolls reports over the last 12 months, typically it falls a lot more on a negative surprise than it goes up on a positive surprise. So the market's aware of this skew. So that's one of the reasons why the dollar-yen is behaving as it is. The question then is the market already positioned for that? And I would be cautious around that, because when we had jolts earlier this week, you could have said the same thing, yet dollar-yen fell dramatically after that. So I would still think that even though the market's already preparing for a weak number, if we were to get a weak number, I do think we'd see an outside move to the downside. So we can still be negatively surprised, even. Indeed, yes. OK.
What does that trade look like if we actually do see a negative number? Is that interpreted, though, as a positive or as a negative? It's very confusing to me of whether this kind of move lower in the payrolls, which historically would be right on par, if that's actually a bad thing.
It's a good question. I would say, it depends which market you're looking at. I think if we were to see a decline in payrolls and an associated rise in unemployment rate, that would have a follow-through to the rates market. The market would then price a 50 basis point cut in September. As for equities and risk markets, I think risk markets, are very sensitive to growth dynamics rather than to interest rates right now. So if we were to see a weak number, I do think risk markets such as equities would take that badly. So rather than bad news being good news, in this case, bad news would be bad news for equities.
Let's talk about this bond market here, because you talked a little bit about how the FX market and how the dollar may be shaking out, but it really feels like it's a function of this move we're seeing specifically in the front end of the curve, right? And this narrowing between, I'm going to say the 2s, 10s, but you can see it across the curve in terms of kind of the yield premium that's offered. In the last 5 days, we've seen a 21 basis point move in the 10-year. What is that about? Is that just repricing, or is that an overreaction, or is that a flood to safety? How would you characterize that?
It's a great question. I think it feels like it's a rerun of what we saw a month ago. If you remember, before last month's payrolls, we saw a similar 20 basis point drop in the run-up to payrolls itself. And it's really back to this question of, number one, the market getting worried about a recession. So sort of globally, data over the past week has been quite poor. Could sort of indicate that. If you look at commodity prices as well. And the other one is the market is trying to work out whether the Fed will go with a 50 in September. So the market's kind of oscillating around that all. So that's a big factor within this all.
Bilal, what does your level head make of the conversation around 50? Does that feel overdone to you for September?
Personally, I think it is a bit overdone. That said, I think that if we were to see a higher unemployment rate today, I think we would go 50 in September. Broadly speaking, I think 25 makes most sense. Also, we do have an election coming up as well. And I think if you go 50 ahead of an election, you do risk getting a certain candidate in the US electoral race upset.
I mean, have you asked your AI model what it expects?
for the Fed in September?
Yes.
Yeah, we haven't quite developed the model to forecast the Fed meeting, but we will next time we speak.
We'll get to that. We've got inflation next week as well, haven't we? So you can factor that into the model's thinking. So if 50 is overdone, if we're looking at 25, I mean, do you characterise what we're seeing in the US then as just still within the realms of soft landing, almost normalisation, rather than anything more epically gloomy, or do you want to reserve judgment until later this afternoon?
No. I mean, I'd be happy to say now, I don't think we're entering a recession, anytime soon. I do think that there is a slowing of the economy. There is a sort of slowing in the level of hiring, but there's no clear evidence that there's massive layoffs occurring in the economy, where even if you look at the Challenger job data, that's not showing big sort of job losses. What we're seeing is decline in companies being willing to hire and an increase in the workforce through undocumented workers, for example. But if you look at, say, GDP in Q2, it was very robust. If you look at personal income, personal spending is robust. None of these things are signaling a recession at the moment.
Well, let me push back on that idea, though, in terms of the kind of slowdown. You're right. The people are slowing their pace of hiring. But isn't that a point of concern itself, given that so many of the companies that were pushing the hiring spree, I'm pointing to your Apples, your Microsofts, your Amazons, et cetera, they're not replacing the workers that are quitting. You fold in the immigration story, which has also been spurring this economy. It may not be a slowdown or a recession right now, but aren't these the early signs of it? I mean, kind of what else do you need to see? Are we just waiting for that moment where we're looking at widespread layoffs? Is that the point we need to get to say, all right, well, that's a recession?
Yeah, it's a great question. And one thing in general I would say is that all the indicators that we typically look at to call a recession have all failed terribly over the last year or two. So ISM's been really weak. We didn't get recession. Yield curve inverted. We didn't get recession. So there's been all sorts of noise in the data. Even the unemployment rate, that it crossed the SARM rule last month, the so-called SARM rule, 0.5% move above the 12-month low. Typically, that gets triggered when you're already in a recession. And there's no evidence that we already are in a recession. So I'd be very cautious. For me, I would think that we need to see a decline in personal income, personal spending. We need to see a decline in household balance sheets values, I think, and there's no evidence that's happening. So when that starts to happen, then I think you have a much stronger case for a recession.
What does that then mean for the range that I'm bringing it right back to the bond market, for the range that the 10-year, the 2-year, if you prefer, will actually trade in? Because it feels like, although we're seeing that move lower, to your point, it could reaccelerate ahead of the U.S. election based on the inflation stats. Give us a floor and a ceiling.
Yeah, I think that in general, I would say that the dynamics of the bond market right now are that it's itching for yields to continue to go down. It just seems like the market just wants it, to sort of push lower and lower and lower. And I think the difficulty right now is if the Fed goes 50, and there, of course, is a chance they go 50, then the market will say, OK, they go 50, we need to start to price other 50s thereafter. So for that reason, I think you could easily see bond yields go down towards, say, 3.5, possibly even. My own view is in
the next 2 weeks?
Not necessarily in the next 2 weeks, but in the next few months or so. In the next few weeks, I think we could see another 5 to 10 basis points declines in yields. But my base case is I think that a lot of the declines have probably happened, and we'll probably see some stabilization in the next few weeks.
It seems like a lot's resting on the consumer then, if that's the case, Bilal, if the markets are focused on the growth story and all you described there. We spoke to a guest from UBS earlier on today who was talking about how actually we've seen jobs. Yes, we're seeing cracks in the labour market, but a lot of people in the US have jobs. The labour market is tight. Wages, real wages, not looking so bad. And so actually expecting some sort of stabilisation on the consumer front. How would you describe the consumer at this point?
Yeah, I would say that the consumer is actually doing relatively well. So if you looked at the Q2 data, consumer month-on-month consumer spending was picking up, and the July data also showed it sort of picking up. So just as capex is coming off in the US, you're seeing consumer spending picking up. So sort of the growth pattern has been passed on from corporates to the consumer, and I think that's an important trend that we'll probably continue to see in the next few months.
Yeah, on that subject of capex, then that takes us to AI, and that there's much hope attached to AI in many parts of the market at this point, it would seem. So if capex is coming off, does that tell us something worrying about AI and the prospects for AI?
I think it does. I think what this tells us is that the narrative of this AI mania is probably, we're probably past the peak of that, mania. I think last year was the hype. This year's about the reality. How can you use AI? And every company is discovering it's really hard to find true use cases beyond nice little demos. And we're finding at Macro Hive, we're using a lot of AI stuff. It's a real grind to kind of find out the real nuggets where it works really, really well. It takes a lot of effort to do that. And I think every company is finding that. And so I think this is a point of realism. And so as a result, I think there'll be a sort of less aggressive sort of push into AI by multiple companies.
Yeah, that's a really interesting observation, isn't it? And it chimes with what we we heard from various analysts on Monday that, sank the Nvidia share price 9%, that we need to see this spreading to other parts of the economy. I think it's also interesting that there are some areas that you no doubt there is opportunity in AI, like pharma and drug discovery. But when we spoke to Sandoz, I think it was earlier this week, they were saying, well, actually, we use a lot of AI already. So that's another reason to be perhaps a little more cautious about AI expectations.
And there's always the question of monetization, to your point. There's so much CapEx investment at your own firm as well, as you point out. And then they were waiting for to come back. But I'm wondering if we're waiting for that return on investment, does that catch up to a lot of these companies that might be running out of cash, might be running out of the stimulus, might be running out of the extra issuance that they've been sitting on? At what point do you start to see a liquidity crunch from corporates themselves at a time when we're already seeing the consumer less willing to digest price hikes?
Yeah, absolutely. I think this is going to be a particularly challenging time for corporates, over the next few months. If you look at overall valuations of stocks, they're expecting quite strong earnings growth in the next 12 months. And so to realize those earnings, it's going to be very, very hard. So I think there will be a pullback. There will be many companies starting to scale back or go down, unable to raise a requisite capital to fund that all. The one kind of interesting dimension to this is the larger big tech companies, they're all reiterating that they don't care about profitability. They're going to invest massively in AI and so on. So whether it's Microsoft, Apple, and Amazon, the twist with this one is that normally these companies are independent of each other. They aren't really direct competitors. This is probably the first time in multiple decades that they're going head to head. So it's a zero-sum game now. One gains, someone else loses. So that's another factor that could see profit margins sort of challenged. So all of this is kind of giving quite a gloomy outlook for the corporate sector.
Well, the luxury that they have and the names that you're talking about is they're sitting on trillions and trillions of cash they can't deploy in terms of acquisitions or buybacks or whatever that may be. So AI feels like the only correct alternative. Bilal Hafeez, we have to leave it there. Fascinating conversation. CEO and Director of Research over at Macro Hive. We talked